An 8% yield is not an 8% default forecast. The real question is what the 500 basis point spread is pricing. Start with the yield. 3% is Treasury compensation. The remaining 500 basis points is the credit spread. That spread matters because U.S. corporate bonds are an $11.5 trillion market, and high-yield spreads jump by regime. So do not ask only, will companies default? Ask how much of the spread default can actually explain. Expected loss is default probability, times loss given default. Using 3.9% default and 62.4% loss, given default gives about 243 basis points. Against a 500 basis point spread, that leaves a large gap for fear and friction. Now, flip the logic. If the whole spread were default compensation, the implied risk-neutral proxy is about 8.01%. That is much higher than the historical default input, so the spread is not a physical default forecast. A better mental model is a stack: default, tax, liquidity, risk premium, and panic. The exact stack changes by rating, maturity, recovery, and market regime. Then the spread becomes a price. A higher yield means a lower bond price. In the toy 5-year bond, 8% prices near par. 13% creates roughly a 17.6% price hit. So a spread prices default plus fear plus friction, not default alone. Sources include SIFMA, Fred ICE Data, Reuters, S&P, Makeda, Moody's, Elton, and Longstaff. Educational only, not financial advice.